we were talking during the break, and you mentioned 2023 is a year where the economy is one thing, the markets is another thing. The market's made up its mind that we're done with inflation. Do you think that's accurate?
It seems to have, but keep in mind, we've had a lot of head fakes on that front. We've had several rallies, even going back to June of last year and then in the fall again, and then all of a sudden the data starts to say, whoa, maybe we aren't so under control. So I still think there is some risk still, and the Fed needs to be very conscious of that. But I think overall, we have priced quite a bit into this market, both from a risk perspective, equities, interest rates, et cetera. So I don't think it's the same as last year. And as I kind of said in the break, for us, it's kind of the narrative of the market is one thing, but the economy is something else. And they often don't rhyme in short periods of time.
And what's the best way to kind of play it for 2023? Is it still fixed income, but where people are saying, look, I see a little bit more coupon, I see a little bit more income now. That's the way to play it more than the equity market?
The safest way from our perspective is that there's no doubt last year was a disaster for fixed income instruments. So if you're thinking about things from a risk-adjusted basis, there's quite a bit of opportunity in the general fixed income markets, whether it's EM debt or even if the credit markets, particularly on the investment grade side. So risk-adjusted fixed income looks pretty good to us. But I wouldn't rule out some of the equity areas. I think this is a year where we could see equity returns that are a little bit disconnected from some of the economic data that we're publishing, just because we've priced in a decent amount. I'm not saying equities are universally cheap, but they are not expensive anymore. And particularly outside the United States, if the dollar stays under control, there's some opportunities to see a little bit of outside surprises when it comes to certain equity gains in 2023.
Like what?
I think parts of the Asian market in particular. We're actually quite keen on Asia right now. And we're not saying it's a long-term structural shift to stay overweight Asia, but at least in the interim, we think with the China reopening dynamic, some of the sentiment shifts and the technical shifts that we've seen in the market here, we do think there's a little bit more to run in some of the Asian economies, particularly on the EM side.
And is it still to play China specifically, or do you look elsewhere?
China is a key one. I would focus a little bit more on the North Asia countries. Obviously, we've seen some relative outperformance in the South Asia countries over the last 12 to 18 months, and perhaps we're going to see a little bit of a shift in investor sentiment more towards the Asian northern countries, including China overall.
Does that include Japan?
Japan to an extent. Japan is a tricky economy, I think. They have some challenges to deal with. There may be some surprises from their central bank, possibly. So we're not outright overweight Japan specifically. I would lean a bit more towards Korea and China from the perspective of what we're thinking about with North Asia opportunities.
And I guess you mentioned how you can't rule out equities. I'm just wondering, given last year was all about this breakdown in correlations between stocks and bonds, and people are saying, look, I can believe in a 60-40 portfolio again for at least this year. What could reassert that correlation again?
Well, there's a lot of risk still out there. I mean, are we truly in a structural shift where we need to be in an environment where interest rates globally are just going to stay higher at a much higher level than we've been accustomed to for the last 30 years, which coincides with an environment where inflation stays structurally higher for a lot longer than people think. Our base case is inflation is not going to return to the 2% type of levels that we saw pre-COVID, but that structurally there's only a small component of an additional inflation, and someone that's driven by some of the dynamics that are pushing inflation higher, because we do have climate transition dynamics that are pushing inflation higher. We do have the idea of deglobalization that are pushing inflation rates higher. But at the same time, the long-term themes of demographics, massive debt loads around the world, increases in productivity through AI and technology, those are still downward trends on inflation. So there's a bit more of a teeter-tot there than there used to be with these other dynamics that are a bit more inflationary, but those non-inflationary dynamics are still in play.
What do you think about commodities? Generally speaking, whether that's an equity market iteration or what that means precisely for commodities themselves?
We think commodities, just given the general risk that we still see, particularly on the supply concerns, that there is still going to be a premium embedded in some of the commodity prices. On top of the fact that we have the China reopening dynamic and perhaps some of the world starting to see some real recovery again. We're not saying that we're going to see oil go back to the peaks that we saw last year, but I think oil does have a pretty good floor on it, as well as some of the other physical commodities that are particularly more industrial in nature.